One of the hot topics at REIT Week 2009 is the government's TALF program, aimed at boosting liquidity in the financial markets. We're joined today by Ken Rosen, chairman of Rosen Consulting Group, to discuss the program. Ken, thanks for joining us. Could you tell us a little bit about the nuts and bolts of TALF?
So the TALF program is in response to the illiquidity that we've seen in the commercial mortgage-backed securities market and the lack of new originations. And the nuts and bolts of it there are really two portions of it. One is the legacy asset program, which is essentially allowing older AAA mortgage securities to be bought by investors, with the Fed lending 93% of the money and the individual putting up 7% of the money. So it's an attempt to get some leverage back in the market and liquidity back in the market. By doing that, they hope to obviously have the prices of these securities go up, so when they're sold by banks or other investors selling them, the prices will be somewhat better. And it shows up in the secondary market already. The prices have gone up from 60 to about 74, 75 since this program was announced. So it's had an announcement effect. There's also the new origination portion of TALF, which will basically have the same leverage component, same AAA rating, and people will be able to use that to do a new origination of a mortgage and then sell it to investors who have this leverage opportunity. It's a non-recourse leverage, a 5-year term loan from the Federal Reserve. Very unusual, but it's basically saying we need to return the market to some sort of semblance of normalcy. And so the one thing to remember, this has to be AAA securities. So that's a little bit tricky. That means the average loan to value on these loans are going to be 50, 55%, so quite low. So it's not returned to high leverage. It's just saying some money comes back flowing into the marketplace, with the private sector hopefully will follow.
Ken, have there been any recent developments that could impact TALF going forward?
So there are a little bit of a monkey wrench was thrown to the program late last week when S&P suggested that it's going to basically downgrade over 90% of the 2007 book of mortgage securities done from AAA to a lower level, which means they'd be ineligible for the TALF program. So the TALF people are going back and deciding, do they take a lower quality security, lower rated, or do they go based on original ratings, AAA original ratings? So we don't know this yet. This just happened late last week. The price of the securities in the secondary market fell because people thought this would be a problem. So we have, I think it's still a project in the works.
Ken, given the success of REITs in the recent months in terms of issuing both debt and equity, do you think that TALF is still necessary?
Right. So I would say that we're very encouraged by the equity offerings. About $12 billion of new equity has been raised, and a number of companies have also been able to raise unsecured debt in the marketplace at high rates at first and now much lower rates. So the market is getting some of its own response without TALF. But remember, we have $800 billion of mortgage securities out there, commercial mortgage-backed securities, maturing in the next 5 years. That's a lot of money. And I think if we don't get what we call the shadow debt market back, the secondary market back, in some sort of stronger form, I think we need TALF. We need something like this to get this going. It's encouraging that the REITs have been able to raise money, but the REITs are only a small portion of the overall debt outstanding. And even, it's the best names that have raised debt. Everyone hasn't been able to raise debt at reasonable rates yet. So I think we need it.
Ken, thanks for your time. For more information on REIT Week 2009, turn to REIT.com.